Hey guys, welcome to today's training video where I'm going over SPX weekly options. I'm going to show you a trading strategy that works even if you work full time. And so again, I'm going to start off here to map out what exactly is going on. Then I'll jump into the chart to show you how to actually execute these trades. So let's jump in. For those who are starting off, you may be like, okay, SPX, cool. What's SPX and how does it compare to SPY? So we have SPX and we have SPY. Both of these track the S&P 500 index. So the S&P 500 index is an index that tracks the 505 most popular stocks in the economy. Again, they're added and adjusted based on just what the economy is doing. And so again, these track how the overall market and economy health is from a stock market perspective. Anyways, SPX is a non-tradable asset. And what I mean by that is you cannot buy shares of SPX because it's the index. You can see here, it's literally the S&P 500 index. It's priced around $4,369. Now again, SPY tracks the S&P 500 index but as an ETF, which means you can buy shares of this. Anyways, let's talk about how the options differ and why you might want to pick one over the other, because this strategy not only works the one that I'm going to teach you today, not only works on SPX, but also works on SPY. So this is going to be your move to pick which one is best for you. Anyway, let's start off with SPY. SPY is great for any account, again, especially smaller accounts. Let's say a 5K minimum, or it could even be a $100 minimum, but just to give something, let's say a 5K minimum on SPY. SPX is going to be looking, if we have a 5K minimum on SPY, then we'll want a 50K minimum on SPX. Why is this? Well, because SPX is 10x of SPY. So SPY is currently trading around $300. SPX is trading around $3,000. So everything here is increased. So again, what is good about this? Well, let's say you're starting to size up your trading, starting to take, let's say, 50 contract sizes on SPY, and that's leading to a lot of commissions because your trade size is 50 each. Well, it's 10x the size. Since it's 10x the size, in order to get the same amount of profits, you can do 10 times less the amount of trades. So again, you'll do 5 contracts instead of 50 because you'll be dividing by 10. So you'll only need to do 5 contracts. So what does this mean? It means that you can use less contracts and create the same return as you would if you're trading SPY. Not only that, SPX has the advantage of being cash settled. So again, cash settled is a beautiful thing versus assignment risk. So what is this? Well, when you're trading a stock option, you have assignment risk, which means that if it expires in the money, they can assign you the stock for your option. SPX does not have a tradable asset. You cannot buy a stock of it. So if it expires in the money or against you, then what's going to happen? Nothing. They just simply settle it as cash. So there's nothing to worry about there. And last but not least, the biggest advantage of SPX over SPY is going to be tax advantage. So again, you're taxed at what is, I believe, 60-40. So again, ignore my terrible mouse drawing, but 60-40 advantage. Again, this is not applicable to SPY. So this means that of the income that you make trading SPX, 60% will be taxed at your normal income tax bracket, and 40% will be taxed at a long-term tax bracket, which is a lot lower. So which one should you pick moving forward? SPX is going to be for people with larger accounts. SPY will be for people with smaller accounts looking to scale. That's all this is. Now, the strategy, now that you know which thing you're trading with, is based around trend following. The idea of that the market follows a consistent moving pattern. If you're seeing the market highs get higher and higher and higher, and the lows get higher as well, we are in an uptrend. Uptrend means you buy or sell put credit spreads. So again, if you see the market going up, put credit spreads. If you see the market going down, which is the inverse, lows are getting lower, and highs are getting lower and lows are getting lower as well. This is known as a call credit spread. Why? Well, because put credit spreads make money on the way up, call credit spreads make money on the way down. So let's break this down. Okay, how do I know if the market's trending up or down? Well, you can simply just look at the stock. Okay, does this look like it's moving up? Yeah, in general, this looks like it's moving up. It looked like it was moving down here. Now it looks like it's starting to move higher. Okay, cool. Put credit spreads. Next, another way of deciphering trend is by looking at the moving average, which is what this blue line is here. You go to the indicator section, you add the moving average line, and you see what's starting to trade up. And again, you can see here it's starting to move up because you can see this blue line here, which is the moving average line, is starting to point up. And so since it's pointing up, you can be here, okay, cool, we're moving higher. This would be a put credit spreads trade. Cool. Now, where do you enter your put credit spreads trade? Well, this is the beauty and why anybody can do it, especially those who work full time. All you need to do is come in here, whether the market is open, closed, whatever. You come in here, where's the nearest support? Let's say around 4,300. Okay, cool. You set an order for 4,300. You set a limit order, which means that once it fills, the credit spread trade fills at that level, then you don't have to do anything else. And when you set a limit order, you also don't have to be around for the order to fill, which means if you're in a meeting and your credit spread limit order is hit, it will enter the trade for you and you'll be able to enter a trade without having to do anything. So again, using limit orders. So again, with credit spreads, if you've never heard of a credit spread, the way that these trades are structured is you pick a level that you're betting the stock will stay above for a put credit spread. So for instance, we're picking this level. Why? Because it's previous resistance, which will now be support. It looks like it's dipping down in a current uptrend, so it's probably going to reverse here and start heading higher soon. So again, what we see here is that this level, if the market stays above this level by my expiration date, then I make money. So for instance, let's say that our expiration date, because these are set it and forget it trades for people who work full time, let's say we're going about 3 weeks out, okay? So in 3 weeks, if the stock stays above this level, no matter what it does, let's say it does something like this, and it closes here, then again, I will make money. I will make about $20, okay? Now, if the stock goes below this and closes below it, then I will lose $80. This is roughly with a $1 wide spread. That's not exactly how it works on SPX, but just for general concepts. That's how this works, okay? So again, more times than not, these trades, especially when you're trading with the trend, have an 85 to 90% win rate. That means you're gonna win most of the time, and again, you'll have a 20 to 80% win rate. That's exactly how these trades are structured. If you wanna learn step by step how you can place these trades and the rules behind it, click down below and check out the trading handbook. Again, if you want access to these alerts for you so that you don't have to worry about where to pick, you don't have to worry about doing all this technical analysis, finding the right stocks, going to SPX, whatever it is, then again, I have it right here, SPX Trade Alerts, which tells you exactly what to do. For instance, this alert came out yesterday. Again, I have a 93% win rate, historically speaking. If I trade this, I have a 15% annualized return, which means I will double the average market return. And it tells me exactly what to do, the expiration of the option to pick, a put credit spread to put on, the levels to put on, and everything like that for you, as well as the minimum credit that I need to collect in order to put this trade on. So this is everything you need to know right here for you. Now this right here is called my 10% Credit Spreads Inner Circle program. This program is only open 4 days a month and then closes, so I can spend the rest of the month focusing on my members and ensuring they have success with credit spread trading. And so right now is the first day this program is open. It will close in 3 days, so if you miss out, you miss out, and you won't be able to join until next month. So anyways, guys, if you're interested in trading credit spreads of any kind, SPX, XPY, whatever, to generate consistent monthly income, check out this program. First link down below. All right, guys, I will see you in the next video.